whenever we trade in the stock market, we buy shares of a particular company. So whenever we buy a particular share, we have to pay a certain cash amount and you will get delivery of that share. You are buying into a company. You are buying the equity of that company. So this is called equity trading. It's also called as spot and cash because it has to be spot settled. You are actually paying cash. You get delivery after a certain amount of time, that is T+1 or T+2 according to the various exchanges in the world. So this is how equity or spot or cash markets work. When you pay 100 rupees to buy a share, you are paying it on the spot. So you're not taking a loan or you're not taking leverage. So this spot transaction is why it is called a equity cum cash cum spot market.
So let's understand what equity futures and what spot actually means. First, I'll open the National Stock Exchange website, and I'll also open the BSE India website, that's the Bombay Stock Exchange website. Now here we'll select equity. Let's select Reliance. Reliance is trading at 975 rupees. And BSE, let's open Reliance again. And you'll see we get all other Reliance companies. I'll select Reliance Industries. And we can see that it's trading at 975.95. Now, if I want to trade Reliance in the equity segment, notice that this is equity BSE. Its equity is well. You will notice that all I need to do is pay 975.95 rupees and I can own one share of Reliance. It's pretty simple. I pay what you see and this is called spot. It's called a spot transaction because the settlement is happening on the spot. You want to buy one share for 975.95. Someone wants to sell that share and you get that one share in exchange for paying that full amount. Now the question is, if you are paying the entire amount in equity, it's called on the spot. That makes sense. But in what case do you not pay the full amount? Well, the answer is derivatives. So let me go here and change this to equity derivatives. I'll type Reliance now and you'll see that I'll get Reliance futures. Now this is also priced at 979.25, but can I buy one share of Reliance futures? The answer is no. Let me zoom in over here for you. Here we have something called market lot. Now market lot means 1000 shares is the minimum amount of shares you have to buy in order to trade this future contract. So I cannot buy one share or 5 shares or 100. I need to buy a minimum number of 1000 shares. So how much are you paying? You're paying 979.25 times 1000. Let me multiply this very quickly. That's 979.25 multiplied by 1000. That is 9,79,250. Now in derivatives, I don't need to pay the entire amount. We need to pay about 1.25 lakh rupees of margin to control about 9.79 lakh rupees worth of stock. Notice you have leverage here. You're paying a small amount of margin to control a large amount of contract. Now this, the settlement, has not really happened. You've only paid a fraction of that entire amount. So look at this. When you own one lot of Reliance futures, you're controlling almost 10 lakh rupees of contract value by paying a little over lakh rupees. So the settlement for this will happen in the future. This case, the expiry is much later. So when and if you do take delivery of this futures lot, you have to pay the entire amount then. And then the transaction would be settled. So this is the difference between Reliance equity, where you're paying on the spot, you bring the full amount, versus Reliance derivatives. Whether it's stock futures or writing options, you have to pay a margin to control a large amount of stock. Just remember, normal equity is called cash transaction, it's called spot, and it's also called an equity transaction. So don't get confused with these words.
In terms of liquidity and volume, the major currencies that are traded in the Forex markets are as below. We have the New Zealand dollar, We have the Canadian dollar. We have Great Britain. We have Switzerland. We have Australia. We have the Eurozone. We have United States and Japan. These countries are the G8 countries. Each of these countries have their own currencies. Now, how do we evaluate or find out the value of a particular currency? There is no absolute value when it comes to foreign exchange. The value is determined in terms of the relative value with respect to other currencies. That is, if you have 1 euro, how much USD does it take to buy 1 euro? So it's like a tug of war between two different currencies. So Euro JPY means the value of euro is determined in terms of the value of JPY. So there is the base currency and there is the term currency. So currencies are always traded in pairs.
So the value of a currency can only be seen against another currency, right? So let's start with the USD INR. I think you would be familiar with this and it's a great place to begin. So this is a chart of the value of USD INR against each other. Now if you look in 2018, let me zoom in. If you zoom in, you'll see at the start of 2018, the value was 63. Now 63 means you would pay 63 Indian rupees to get $1. So remember, whatever currency you have on the right, that's how much of the currency you need to pay to get the one on the left-hand currency. So here you need to pay 63 rupees to get $1. Today, however, you need to pay 68.6 rupees to get $1. So let's see the most liquid currencies that are there in the Forex market. First, we'll begin with the USD Euro. So the USD Euro. Now in the USD Euro, you'll see that around the start of 2018, that's around here, you would have to pay 0.8 of a euro to get $1. Now when in such a situation you get a 0 point something, this means the euro is stronger when compared to the US dollar. Today, of course, you need to pay 0.85 of a euro. That's less than 1 euro to get $1. But seems like this is going upwards. So if it were to continue go upwards, soon 1 euro would equal 1 USD. The other currency pair is USD JPY. At the start of 2018, you would see that you have to pay 111 Japanese yen to make $1. And then slowly that decreased, which means the Japanese yen was becoming stronger because you had to pay less Japanese yen per dollar for the exchange value. But now it's going back up. Let's see another currency pair which is also very liquid, the USD GBP. And GBP stands for Great British Pound. So here you'll see in 2018, you would have to pay 0.73 of a British pound to get $1. The British pound actually became stronger. It's a little opposite in Forex markets. When the chart goes down, that means the right-hand currency is getting stronger. And when the chart is going up, that means the right-hand currency is getting weaker. And by right hand, I mean USD against the British pound. So British pound would be the right hand. So as the markets are going down, this means the British pound is getting stronger because it's taking less British pounds as an exchange value to get $1. Another liquid Forex pair is the USD CHF. CHF means the Swiss franc. Again, we see in 2018, the value was 0.97 against $1. And currently it's about the same. which means 1 Swiss franc when compared to the dollar, the Swiss franc is slightly more stronger than the dollar. But if you look very close to the 1 mark, which means a dollar is almost equal to a Swiss franc. Next, we have the USD Canadian dollar. Now, I'm sure you've got the hang of this. In 2018, you had to pay 1.25 Canadian dollars to get 1 US dollar. Now you have to pay 1.3 CAD dollars to get 1 US. Another liquid currency pair is the USD against the Australian dollar. That's right, the same thing here again. Finally, we have the USD versus the NZ, that's New Zealand dollar. And over here, it takes 1.48 New Zealand dollars to exchange 1 US dollar.
So there are two main exchanges in India. In terms of volume, the NSE has the highest volume. Then there comes BSE. Then there is also a Metropolitan Stock Exchange, which is a new and upcoming exchange. But the two main exchanges are mainly BSE and NSE. Shorting is a very peculiar feature in the share markets from which you can make money out of falling prices. So let me explain how shorting works. Let me give you an example with a pack of Duracell batteries. One of my friends requires a pack of Duracell batteries, but I don't have it. What will I do? I will borrow it. Thank you. So this pack of Duracell batteries costs around 100 rupees. I'm going to sell it for 100 rupees. So right now, technically, I have not made any profit on this. But due to some unforeseen circumstances, like the rise of solar cells or new technologies, the price of these batteries goes down. If I go to any chroma store in the market and buy a pack of Duracell batteries, it will cost me around 90 bucks. I can just buy these batteries from there and return it back to Pulkit. Hey Pulkit, here you go. So right now, I have made 10 rupees without using any asset of mine. So this is how shorting actually works. In the share market, you will actually sell first without owning anything. Suppose you have a Tata Motors share, you will sell it first at 100 rupees. By market close, if the share price falls down to 99, you will buy that and clear out your debts. So this is how shorting actually works. You have made 1 rupees without owning anything and using the fall in prices.
So let's understand this idea of shorting with a practical example. Now notice we have 3 positions over here: GSFC, TCS and Apollo Hospital. Also notice the quantity mentioned here is minus 1139 and minus 646 shares. But how can a position be in minus? Well, this is simply because we have shorted Apollo Hospitals, TCS and GSFC. GSFC shows 0 quantity because, well, the position is no longer there. It was initiated in the morning and exited during the day. So let's focus on our first 2 stocks. The average entry price for Apollo Hospitals was 1053.55. The current market is actually higher than that. So we shorted at 53.55, it's at 57.10. And because of that, the profit and loss for today is a loss of 5,000 rupees. The market has gone above our shorting price. Then we have TCS, same thing. We shorted at 58, it's now at 74, which is much higher than the average entry price. This is why it's also showing a loss. Now let me initiate a position and show you. Remember, we're not telling you how and why to short. I'm simply explaining what shorting is. So let's open, say, one of these stocks here, say ICICI Bank. I'll open up the chart. And let's just short this to show you what a short looks like. So this is an MIS order. MIS means intraday. And we short 1 quantity at whatever market price. So if I click sell, that would happen. But I don't have a position in ICICI Bank currently. So when I actually sell, I'll be able to sell intraday. You cannot do this for delivery-based trades, which is also called CNC, cash and carry. So let's do this in MIS where it's allowed. MIS is margin intraday square off. I'll put a market order, so whatever price is available, I'll get that. I'll probably get filled around 276.2. There it goes, it's sold in MIS. I have ICICI Bank sold at 276.7. Now, whenever the price here becomes lower than 276.70, you will see a profit, just like it did a few seconds ago. You see that? The price is a little lower than average and we are showing a profit. Now I can place an exit order. If I want to exit the stock, all I need to do is go to ICICI and buy one MIS share. I'll put a limit at say 276.50. So that's a 20 paisa profit, right? I'll click buy. The order is placed. There it is. Exited ICICI Bank at a profit after shorting the position. We made a 35 paisa profit. Of course, there'll be brokerage and taxes involved, and eventually this trade might be a loss. But this is just to show you that you can short the market and make money from falling prices. So this is how shorting in the cash markets work. If you short derivatives, that's futures, you can actually short overnight and hold it for as long as the expiry date allows you to. So if you want to short for more than a day, you would select futures. So I hope now it's clear of what shorting is and how traders can benefit from falling prices.
All of the pairs are not liquid on all of the venues. Some venues have higher liquidity on certain currencies pairs as compared to other venues. So for example, EBS has the highest liquidity for Euro USD, and Reuters has higher liquidity for GBP USD. If you are trading on Euro USD, you will get the best price on EBS. Whereas if you're trading on GBP USD, you will get a better price on Reuters. So this is how hedging between different currencies takes place between different venues. Whenever we want to trade in the Forex markets, there are two different ways to trade in. So one is the retail way. In retail way, you have certain players like INFX and other retail brokers. So these brokers are not actually sending your orders to the exchange. They are basically market makers. They provide you bid and ask quotes, and you have to trade within these quotes. There is another way which is mostly used by the different banks and the different countries to trade in the Forex market. These are called the ECNs. So the venues that I mentioned earlier, EBS and Reuters, they are actually electronic communication networks or ECNs. In ECNs, you can be a market maker or a liquidity taker. So these two words are very important: market maker and liquidity taker, maker and taker. So maker means you are basically providing liquidity to the venue. So when you provide liquidity, you basically stream prices that you are willing to buy Euro USD at a certain price and you're willing to sell Euro USD at a certain price. You will provide various levels within these bid and ask quotes, as in like the first level will have a liquidity of like 500k USD, the second level will have a liquidity of 1 million, and so on further. The reason that they are market making is something we'll come to very soon in the later stages of this lesson.
So let's understand what market makers are. In a stock exchange, we have sellers and buyers. And usually we have many buyers and many sellers making up a market. However, sometimes there are not enough bids and not enough asks. And this causes the bid-ask spread to widen. You need a lot of players in the markets to make sure they are a tight, close bid and ask spread. In situations where there are not enough participants, you will see an illiquid market, such as this one. To make up for this, we have market makers. Now, market makers will actually stream their own bids and asks to fill up the order book and make the market liquid again. So market makers are constantly putting in buy orders and sell orders and actually trading the security to create the market to make sure there are enough bids and asks to make it liquid. Now look at this Forex level 2 quote very closely. It's Euro USD over here. You can see that the bids are over here and the asks are over here. You can see that the bid size, that's 9,000 units, and this is 4,000 units. And you can also see that there is a difference between the bid and the offer. So 1122 and here it's 1124. So there's a difference over here. This is a very tight spread, which means the liquidity over here is very high. And look how fast the number changes every few seconds. You see this stream of constant bidding and asks? This is what creates a liquid market. Now this could be created by retail participants or even market makers. But market makers are making money through the spread between the bid and offers. So they're buying at 258 and selling at 263. If a market maker can balance his trades, he's making a profit from the spread. But what about risk? Market makers are not people. They are mostly algorithms. Computers sitting there balancing the bids and asks to make sure they've invested a similar amount in the buy and sell side to balance out risk. Their main aim is to create liquidity to make sure they're earning a spread between the bid and the ask.
In equity markets, whenever we buy a share, the minimum unit that we can buy is always one share. Whereas in Forex markets, suppose there's a Cadbury chocolate here. I cannot buy 1 cube of Cadbury chocolate, but I always have to buy 12 cubes of this Cadbury. This 12 cubes is one lot. That is the minimum unit that you can buy. In the Forex markets, the minimum lot size that you can buy is 1 lakh units of the base currency. These 1 lakh unit is a one lot. So it can go down up to 100 units. That is a nano lot. But these nano lots are only offered by retail brokers like INFX and other retail brokers. So in currency markets, usually there is not much fluctuation since currencies determine the future of the countries as well. So the pip is basically the place after the decimal point or the unit where the maximum change will happen. So if there are 4 decimal places for a particular price, suppose Euro USD is mentioned in terms of 1.117. So the 4th decimal place after the decimal point is where the action usually happens. Different types of trading that happen in a market nowadays are swing trading, intraday trading, and the quantitative approach. Swing trading is when you hold a position and dispose it off within a few weeks. Intraday trading is you take a position and you square it off within the same day. Quantitative approach is a whole different beast. The major volume in all the exchanges worldwide is not people shouting in pits or manually trading from their computers. It is usually automated machines which are doing the trading. 90% of the volume in most major venues across the world. Arbitrage basically means taking advantage of the discrepancies in the market for an actual value of a certain product. So the same product might exist with different prices across the marketplace. So in India, we have 2 different exchanges, NSE and BSE. Both are prominent exchanges, both have a substantial amount of liquidity. Suppose Reliance is trading on NSE at 900. So since the same company is trading on BSE as well, we assume that it must be trading at the same price. But it doesn't happen so. Usually it trades 1 or 2% above or below the NSE price. It might trade at 910 or 908 or below 900, 898 or something like that. So Whenever these discrepancies take place, mathematicians try to take advantage of these discrepancies using mathematical models.
So let's start with the analysis. We'll be using R for analyzing. So R is especially useful if we want to generate graphs. So for the wind spread, we have three basically files. So one is the file for the June, one is the file for the July, one is the spread file. So the file for the June and July is basically these two files. That is the best bid and the best ask prices for June and the best bid and the best ask prices for July. So in R, we'll basically load these files. We have loaded these files, the June and the July files. Let's generate a graph for the long. That is the unwind. So here it's basically reading from the CSV files, the July file and the June file, and it has generated a graph in the folder. Now let's see the graph which is generated. So as you can see, there are huge spikes in both the green as well as the red values. Now what are the green and the red values? Let's check it out in our R code. So as you can see, the best ask for July 45788 token is green. And the best bid for June is red. Now according to the formula, the best bid for June is required in the unwind spread. So this graph basically helps us to see the unwind spread parameters. So red is June, green is July. Similarly, we have created a graph for the wind spread. So this is basically long June and short July. As you can see, there are huge spikes which might not be visible in the retail trading platform. Huge spikes as in the price actually goes down somewhere to around 300. So the stable price level for the June is somewhere close to between 305 to 310. But in between it falls to between 300 to 305. So this is where the opportunity for HFT arises. Since these opportunities cannot be utilized by normal retail platforms, only systems with very low latency can see this opportunity arising and take advantage of it, since there is a limited quantity and this opportunity is there for only a short period of time. Now let's see the spread. So our wind is red and the unwind is blue. So red minus blue is your profit. So we take red whenever red goes ahead of blue, and we take blue whenever blue goes below red. So as you can see, there is a huge number of opportunities during market close. So the potential maximum profit that can be gained is The maximum value of spread for the red is 4. It's actually close to 5. Okay, so this is 5 and this is -5. For the blue is -5. So 5 minus of -5, that is 10. So you can earn 10 rupees profit, risk-free profit. You can deduct the transaction charges, of course, but you can repeat this n number of times. So as you can see, if you take a buy, I mean like the wind position here, and you take an unwind position here, the profit that you will be getting is 5 minus 2, that is 3 rupees. You can repeat this n number of times. You can do the same with the unwind. You can keep the wind at somewhere close to 1 rupees, 1.5, I guess, 1.75. And whenever the unwind goes to like negative, just take that opportunity. So for most of the time, the blue is greater than the red. So this is what the retail market sees, but the HFT sees more. So if you repeat this n number of times a day, if you have an alpha which can basically indicate when to take the wind position and when to take the unwind position, you can see that there is a lot of earning to do. And this is just for Tata Motors. You can imagine the kind of spreads that are being offered on Nifty and the other more liquid stocks like Reliance.
So HFT firms usually operate at the bleeding edge of technology. There are two different pathways to go into an HFT firm. So the first is the researcher pathway, in which you have a degree in mathematics or physics or certain applied sciences, where you have a research background so that you can do statistical research. You have sufficient competence in like doing mathematics quickly and understanding mathematical concepts. This is how you become a quant researcher. The second is the technology side of things. So you are interested in programming, you have a very good understanding of data structures and algorithms. You like to do things yourself, you can work in a small team and be very agile. So this is how you can be in the technology side of things. It's very exciting in terms of technology because most of the new open source low latency technologies have arisen due to the needs of the financial world, like the use of FPGAs, use of low latency network technologies have arisen because of the needs of the financial world. I agreed to do this because there are certain myths about HFT. People think that HFT is a bad thing, and people actually don't know much about like how HFT works, because the HFT world is usually shrouded in secrecy, and they are not very publicity hungry, so they don't usually go out and talk to the press that much. So that was my main goal, to like spread some basic concepts about like how HFT works and how it is not a bad thing. It is just taking advantage of certain opportunities that arise for a short time, and it doesn't affect the way that real people actually trade, or it doesn't cheat them. Why I did this for LearnApp is because LearnApp is actually democratizing the distribution of knowledge at a very cost-effective way. Since LearnApp is bringing the best from the different fields of finance and education and technology, I feel honored to contribute to LearnApp and bring my 2 cents here.